Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Australia's economy grew by 0.8% during the March quarter, slightly above expectations. It takes annual growth, or at least 12 months through to the end of March, to 3.3%. To make sense of yesterday's data and figure out where the economy is heading, I'm joined by ANZ Senior Economist Felicity Emmett. Felicity, welcome back to Fear and Greed.
Thanks very much for having me, Sean.
So, were there any surprises in yesterday's data? The top line number, 0.8%, a little bit above consensus.
It was a little bit above market consensus, but was actually in line with our forecast. But, there is a lot of data in this GDP number, so there's always something in there that surprises. I think for us, it was probably the pretty solid consumer spending number, which I think is encouraging because that's what we're thinking is going to drive growth through most of this year. So that was up 1.5% for the quarter, and it was driven by categories that were really benefiting from the opening up of state borders and the general relaxation of restrictions. So we saw transport up solidly, we saw arts and recreation up strongly, and we saw hospitality up strongly, as well as car purchases. So that was an encouraging result for the rest of the year, especially when we think about consumer confidence and how soft that's been. I mean, it does sort of suggest that people are still willing to go out and spend.
Okay, so the national accounts, what's great about it is it really does give you a view of the whole economy, and you get to see what's happening in the household sector, what businesses are doing, business investments doing, what people are putting in their warehouses, inventories, you're looking at net exports, etc. Bring it back to household spending though. That is the biggest part of economic growth, is that right?
That's right. So it makes up about 55% or so of the economy. So it's often the biggest contributor to growth. And it often is, what's driving growth. If you don't have consumers out there spending or confident to spend, then it's really hard to get really strong economic growth.
Okay, so what about business investment? How did that look?
Business investment was a bit better than we expected as well. So pretty solid rise in machinery and equipment investment. Again, another good rise in engineering construction. Now, that strength was a little bit offset by weakness in non-residential building, but overall it was a solid outcome, up about 1.5% for the quarter. So that's a good sign. When we look at sort of a longer term business investment as a percent of GDP, it's really quite low. So, intentions are positive. Firms are saying they're going to lift spending, but we'll have to wait and see whether that's actually delivered in the next year or so.
Now, something that did help the 3 months through to March was government spending, thanks to payments, flood payments really, but of course that's going to be a one-off, isn't it?
Yeah, government spending was very strong, both on the consumption side, which captures those payments, but also on the investment side. And that continues the trend really that we've seen for a while. When we look at government spending as a percentage of GDP, it's very high at the moment, but it does look as though that won't be sustained, particularly on the consumption side, which is the largest component of government spending. So yes, we would expect that probably to reverse in the current quarter, the second quarter.
Okay, do you have a feel for how the current quarter is tracking?
Oh, look, it's early days, really. But, the retail sales numbers that we had out last week for April were quite promising. We know that a lot of construction work wasn't done in the first quarter because of rain and floods. And while it's still pretty wet in Sydney, I think that they will be able to get a bit more work done in the second quarter. So that's promising as well. What will be difficult to predict is how inventories and net exports together move. So we had a really large subtraction this quarter from net exports and a pretty solid contribution from inventories.
Okay, so I'm going to jump in and break that down. So for listeners, so when we talk about net exports, that's because we're actually, net exports is exports minus imports. And in that instance, it wasn't because we were buying lots more or, importing more goods.
That's right. So imports grew very strongly. Now, some of those imports went into investment, some into consumer spending, but some of them found their way into inventories. So firms might find that they have quite a lot of stock on their hands.
And that inventory measure is an interesting one because that's actually a plus for growth, the fact that they've got lots of stock on hand. That's correct, isn't it?
That's exactly right, and made a pretty significant contribution to growth. All up, when we look at inventories across private and farm and government, they added about 1 percentage point to GDP growth in the quarter.
Stay with me, Felicity. We'll be back in a minute. My guest this morning is ANZ Senior Economist Felicity Emmett. Okay, so Felicity, how do you characterise the economy right now? I know Treasurer Jim Chalmers yesterday, perhaps with an eye to politics, said that things weren't so good, but 3.3% after a sort of for the year through, and then, the year through last year was about 4 and a bit percent. They're not bad growth rates.
No, I think we can say that the economy got off to a pretty solid start. I think, though, what we're seeing, and this is really where the challenge is that, capacity constraints are really biting. We can see that in construction in particular, but we can see it more broadly in some of the inflation measures that came out of the report yesterday. When we look at the personal consumption deflator, which is like the CPI but a bit broader, it rose at its highest rate since 1990, if you exclude the introduction of the GST. So very strong inflationary pressures coming through, and as well on wages measures as well, showing, quite strong gains. And I think this is going to be the challenge for the economy over the next year, is how it manages this very tight environment of very strong demand and limited supply, and how inflation pans out and how policymakers react.
Beautiful segue to next week's Reserve Bank board meeting, Felicity. We've already seen them move once. The economy is going okay, but as you've just explained, there are certainly plenty of inflationary pressures and increasing wage pressures. What do you think the Reserve Bank will do?
Look, after yesterday's report, which showed these inflationary pressures really picking up both on the personal consumption side and on the wages side, we think actually the RBA will probably opt for a 40 basis point rise at the June meeting. Phil Lowe, the governor, said at the May meeting that they would stick to 25 basis point gains unless there was a very strong argument to deviate from that. But I think yesterday's report really shows that these inflationary pressures that we saw in the CPI are really quite broad across the economy. And certainly we're seeing that inflation comes through on the wages side in this broad measure of labour costs that the GDP report.
Okay, so 40 basis points potentially. So inflation / interest rates, wages, they're the biggest risk to the economic outlook?
It's very challenging times. When we look ahead, there's lots of risks, I think, both on the positive side and on the negative side. Certainly, when we look around the world and we look at what central banks might need to do to quell inflation, particularly in countries like the US and New Zealand, where inflation's much higher, I think that creates risks around the global growth outlook. But I think when we look domestically, there are also positive risks. We know that households are in really great shape in terms of their balance sheets. They hold a lot of deposits in banks. They're willing and hopefully able to spend. But the inflation outlook will certainly be a really big challenge, I think, for the Reserve Bank.
Okay. Well, one thing about this, though, is that the unemployment rate is so low. When people have jobs, though, things tend to be doing okay. Notwithstanding inflation, obviously, is the issue. So I'm just parking that for a moment, though. But if people have jobs, things are okay.
That's exactly right. I mean, that is really the best sort of measure of welfare of Australians. And we've got the unemployment rate down to 3.9%, the lowest it's been since the 1970s. So that is a really great situation. And again, that should suggest that people are confident to go out and spend. So we think the unemployment rate will actually go lower through this year and end the year at about 3.3%, which is
wow.
Really an amazing outcome.
Sure is. Do you like days like yesterday where you get to pore over national accounts? I mean, your life is as an economist, at least your professional life is as an economist. Do you enjoy those sorts of days, or are they just too busy?
No, I do. There is lots and lots of data in the GDP report. And even though we have a bit of an idea of what happened, the National Accounts Report provides lots and lots of colour and helps us get a better idea of what the rest of the year would look like. So definitely it's a good day for me.
Felicity, thank you for talking to Fear and Greed.
Thanks very much, Sean.
That was ANZ senior economist Felicity Emmett. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.